Hello students and welcome to the financial system. So students, as we know that we are covering the foreign investments, and in the foreign investments basically what we have, that we have the foreign direct investments, all right, foreign institutional investments and the foreign portfolio investments. Okay, so these are the topics we have scheduled for discussion under the foreign investment series. Okay, out of this basically we have completed the FDI and the foreign institutional investment. So the topics we are left with is foreign portfolio investment, right? So basically in this lecture, what we are going to try, that we are going to try to finish the foreign portfolio investment. Okay, so let's begin. Okay, so basically in the previous lecture, we had finished till there, like we had seen the divisions, we have seen the interest part, and also we have seen the capital gains. So basically now we will continue from here. Foreign portfolio investment is characterized by its liquidity and short term nature. Investors can buy and sell financial assets quickly, making them easily tradable. Okay, like we could say that there is nothing like restrictions on terms and buying and selling of shares and bonds, like in FDI and FII. Okay, like we had seen that in FDI there is a long term, in FII there are some restrictions, okay, on buying and selling of the shares and the bonds. But this kind of thing is you can say not available whenever we talk about the foreign portfolio investments. Okay, basically in foreign portfolio investments they are allowed to infuse the liquidity into the market for short term, and they can quickly and easily buy and sell the financial assets and do the trade easily. Okay, the returns from foreign portfolio investments depend on the performance of the underlying financial assets such as dividend, payment gains, and you can say the capital. Okay, so like you can say that there are nothing like a long term gain and the short term gain. Basically the gains are totally depend upon the underlying financial asset. It means that the nature of financial assets which have been purchased by the, you can say, investor. All right, like if they had invested into the good company, so what will happen, that the profit share of the company will be higher, so does their dividend will also. Second, if we talk about the growth, it means that suppose the investor has invested the money into the growing company, so as long as the company will grow, the capital gains will also grow, right? So it's totally depend upon this. However, the success of the portfolio investment is often based on luck rather than strategic planning or analysis. Why? Because when we talk about the huge capitals like FII and the FDI, basically they prepare themselves for the long-term strategic planning or the analysis. Why? Because they are investing huge chunk of capital, right? That's the thing. But whenever we talk about the FPI, so basically what is happening? In FPI, they are usually the retail investors. Remember, they are not the wholesale investors. And about retail and the wholesale investors, I had told you in the previous lectures already. Okay, so that's why their main aim is depend upon the luck. Okay, so that's why it is written down here. While the foreign portfolio investment can contribute to the growth of the financial markets and provide capital to the countries, it also poses risk, particularly in terms of volatility. So that you could say, suppose if there are there are 10 foreign investors who had invested into the country. Okay, so what will happen? The share market prices will be rises up because of the infusion of the foreign capital. But they are allowed to withdraw their money at any time because they are not bound to the long terms, they are not bound to the restrictions. They could do it easily and quickly. So what will happen? That if they start withdrawing their amount, okay, then what will happen? The market stability will be hampered. Okay, due to this, it is written down that however they are beneficial for the liquidity flow into the market, but also they are risky in terms of the volatility. All right, so keep this thing in your mind also. Governments often regulate the foreign portfolio investment through measures like the capital controls and taxes to manage these risks. The goal is to strike a balance between the stable portfolio inflows and the potential for excessive volatility. Okay, so you could say, however, there is no upper and the lower restrictions on this, but still, because the government is concerned about the stability on the market, concerned about the stability in the market, that is the reason that why the government is, you can say, adopting the approach of stable portfolio influence and maintaining the potential for excessive volatility, right? That is a thing. Thereafter, types of foreign portfolio investments, equity investments. Okay, so the first is equity investments involves buying share of foreign firms that are listed on a stock exchange. When investors buy shares of a company, they become partial owner of that company and are entitled to a share in its profit and growth prospects. So basically, what we have seen in about the equity shares, like in the previous examples, also we had discussed this. Suppose if the company has issued 100% equity shares, right? And this company name is XYZ. All right. There is any other company like the ABC. Okay. So basically, the ABC had, you can say, purchased the 45 equity shares. All right. Then what will happen? That the company will become owner in XYZ by the means of 45% stakes. Right? That is the thing. Okay. Equity investors also have voting rights in the company decision making processes, such as electing board members. Why? Because they had acquired the ownership in the company. So when they have the ownership, it means that they have become liable for suffering the losses and profits, whatever will happen to the company. Okay, so that's why, because these are the ones who's going to be impacted due to anything bad and adverse happen in the organization. Okay, this is the reason why that they are often granted with the voting rights. Voting rights means, what is the meaning of voting rights? Voting rights means that basically they could participate into the AGM. AGM stands for the annual general meeting. Okay. And you can say that every organization once in a year organize the AGM, annual general meeting, in which all its stakeholders, including the equity shareholders, along with the other stakeholders, come and meet. Okay. And they discuss various things about the company's progress and all. Right. So that is the thing, that during these meetings, various, you can say, the proposals presented before the meeting, or you can say presented before the stakeholders. All right. And then to select or reject the provisions, there is the voting. All right. So equity shareholders, because they are the owner of the company, they have got the voting right. It means that they could vote in support of some provision, and also they could vote against of some provision. All right. Equity investments are considered riskier than other types of investments, such as bonds, but they also offer the potential for higher returns. Okay. Like we know that the equity investments bring the ownership, and you can say liability of suffering losses in adverse conditions. Right? So that's why they are considered riskier than the other types of investments, like bonds. Why? Because we know that bonds is a fixed return. All right. Doesn't matter whether the company is in the profit, whether they are suffering losses, you are entitled to receive your fixed return. Okay. The value of the equity investments can fluctuate based on market conditions and the performance of the company. Like you can say, suppose you had purchased 40 equity shares. Okay, let me write down at the blackboard. Like 40 equity shares at 1,000. All right. So how much amount you have spent it? Rupees 40,000. How much? Rupees 40,000 you have invested. Got it? All right. But there are two conditions. First is a appraisal. Second is depreciation. Let's talk about them one by one. If we go with the first condition, suppose right now these 40 shares are now available at 1200 rupees. So how much amount you will get? 48,000, right? Okay. This is a appraisal case. But what if instead of this, only 800 is remaining the value? So how much amount you will receive? 32,000, right? So you could say, doesn't matter at what point you had bought the equity shares. They are totally depend upon the fluctuations, which are basically, you can say, depend upon the performance of the company. All right. Thereafter, the bond investments. Bond investment involves buying bonds issued by the foreign governments or corporations. Bonds are debt instruments where investors lend money to the issuer in exchange for a periodic interest, payments, and the return of the principal amount at maturity. So you can say bonds are like, suppose this is an XYZ. All right. XYZ had issued the bond for rupees 10 crores at 10% interest rate per annum for 10 years. It means that if anyone wants to purchase the bond, the person is required to submit rupees 10 crores to the government for the time period of 10 years. In return of it, the person is entitled to receive fixed amount of 10% on annual basis. So you could say that the person or the purchaser of the bond will receive 1 crore rupees at the end of every year up to 10 years. Or you can say till the XYZ will buy back the bond. All right. So basically what generally happens that the foreign governments and the corporations issues the bonds in Indian markets. Okay. And the interested Indians who having the amount and who are looking for the fixed return, also called as stable return. All right. So they could buy that particular bonds. All right. Bonds are considered less risky than the stocks because they offer a fixed rate of return and have a predetermined maturity date. It means that suppose if the bond is for 1 year, so 1st January 2004 to 31st December 2004, that will be the time period. Okay, if we take the calendar year and if we take the financial year, so suppose 1 April or 1st April 2004 to 31st March 2005, that will be the financial year. So if the bond is for 1 year, all right, so during this time period, either annually, quarterly, or you can say half yearly, the person who had purchased the bond is entitled to receive the fixed return. And after the completion of the time, the bond will be repurchased. Okay, so that's why they are called as a less risky. Bond investments can provide a steady income stream through interest payments, making them attractive to the investors seeking income. Like if you're not looking for the capital gains, long-term profits, and other things, you just want a fixed portion to come to you. Then basically you could go with the bonds. Why? Because they having the fixed interest payments. All right. However, the bond prices can also be affected by interest rate changes and credit risk associated with the issuer. All right. Thereafter, now we have the money market investment. Money market investments are highly liquid, safe, and the short-term investments in the securities, such as the treasury bills, bank certificates of deposits, commercial paper, and the short-term bonds. So about this, we had already discussed, like we know what are the treasury bills, all right, what are the commercial papers, and what are the short-term. But here is the one thing: bank certificates of deposits, also known as CDs. Like what is this? So basically, you could say if we talk about the saving account, okay. So saving account having the facility what we called as a demand draft, right? So you could say, suppose if you have submitted certain amount in your saving account, whenever you required, you could withdraw it, right? This is called the demand draft. But basically, you can say the certificate of deposit this certificate of deposit is somewhat different. Is somewhat different. And why I'm saying this? It is a type of the saving account, but savings are for fixed duration. It means that up to certain time period you are required to submit your amount and you are not allowed to withdraw it. All right. These investments are considered low risk and provide a way for the investors to park their funds temporarily while earning a modest return. Okay. It means that they having low to medium returns. All right. However, the high returns are often, you can say, the high returns are often connected with the high risk. Okay. But if you are going with the fixed income and the fixed, you can say things. So basically, they are providing the low to, you can say, medium or the moderate returns. All right. Money market investments are typically used by investors to preserve capital and maintain liquidity. They are often used as a temporary haven for funds awaiting investments in longer term assets or to meet short term cash. Okay, so you can say that basically, you can say the investor who is investing the amount, he is preserving the capital. Why? Because the capital is having predetermined maturity. Okay, like we could take an example. Suppose if through the certificate of deposits, I have submitted rupees 5 lakh into the account for 6 months. So if I had submitted the amount in the month of July, it means that I am eligible to withdraw it in the month of December, right? That is the meaning of it. Okay, so basically, that is the clear picture. All right, that's the clear picture. Like it means that it's having the predetermined maturity. It means that in the month of after the month of December, I am eligible to withdraw my money. Second is maintain liquidity. What does it mean? It means that I am entitled to receive the fixed, you can say, portion as an interest. So suppose you can say if 10% or not 10%, you can say 5% is promised to me. Okay, then 5% of rupees 5 lakhs is 25,000. It means that on the fixed or the regular basis, I will receive 25,000 as a payment of interest. Okay. Thereafter, the factors which affecting the foreign portfolio investment. First is the economic growth opportunity. Countries with higher growth prospects are more attractive to the foreign investors. Strong economic growth indicates a potentially lucrative market for investments, leading to increased foreign portfolio investment. Okay, like we could say, suppose if there is you and here is me. Okay, and if I'm saying that you should invest in my company and I will give you this and that was what. Okay, so what will be your first question? That what is in what is in it for me? It means that every investor first see the benefit of himself. Okay, so that is the reason that this is a basic, you can say, very basic question should come in our minds while we are making investment. That what is in it for me? All right. So the countries with higher growth prospects are more attractive to the foreign investors. Strong economic growth indicates a potentially lucrative market for the investments, leading to increased foreign portfolio investment. All right. Thereafter, the interest rates. Higher interest rates in a country make investments in that country more appealing. As investors can earn higher returns, lower interest rates, on the other hand, may discourage foreign portfolio investment. Like you could say that if I'm the investor and I am parking my money somewhere else, then what should be my call? My call should be higher return. Okay. So if I'm getting option in two countries, one country is offering high returns, another country is offering low returns. Then what should be my call? Obviously, I will go with the country A. All right. Thereafter, the risk return trade off. Investors consider the expected returns on financial assets in a country relative to the risk involved. Countries offering high returns for a given level of risk are more likely to attract foreign portfolio investments. Like as I have told you, that always high returns are equal to the high risk. Okay, high returns are always you can say equal to the high risk. All right, but which kind of risk? The risk must be calculated. The risk must be calculated. Why? What is the reason behind it? Basically, the calculated risk is always you can say beneficial in comparison with the uncalculated and you can say underseen risk. Why? Because when you see the risk potential and you having the idea of the calculated risk in your mind, then you could easily design your policies. But if you are going to face the risk in which you have no idea, then what will happen? The things will be in adverse condition for you. Okay. So the investors consider the unexpected risk you on the financial assets in a country which are related to the risk involved for the high returns. But for given level of risk, or you can say up to the calculated risk. All right. Currency movement. Depreciation of the local currency can make investments cheaper for foreign investors and increase the potential returns when converted back to their home currency. This can boost inflows of foreign portfolio investment. Like if we talk about, suppose, if there is someone from USA and this is India, all right. So you could say that if there is a need for 80,000, there is a need for 80,000, then how much this person is required to invest? Only 10,000 US dollars. By just investing 10,000 US dollars, how much amount he will generate? 80,000. Got it? So here you could see that for him, the investment is beneficial because he is investing less and gaining more. All right. Obviously, the political stability. The countries with stable political environments are preferred for the investments. Why? Because political instability, like the frequent changes in the government or the civil unrest, can deter foreign portfolio investment due to the increased risk. Like the government policies having a significant impact on the performance of the companies due to the trade policies and all. All right. So that's why the political stability is much required. Regulatory environment, transparent and the investor friendly regulatory environment is crucial so that it could attract the foreign portfolio investment. If the strict regulations are there, then what will happen? Maybe the foreign investors will find themselves discouraging. All right. Macroeconomic stability. Countries with stable macroeconomic conditions such as low inflation and manageable fiscal deficit are more attracted to the foreign investors. Financial market development. Well developed financial markets with a wide range of investments options are more likely to attract the foreign portfolio investment. It is very obvious. Size of local capital market. Larger and more liquid domestic capital markets provide a foreign investors with more opportunities to deploy their funds and diversify their portfolios. Volatility of returns. Like you could say, high volatility in returns on the financial assets in a country can make foreign investors wary and affect the inflows of the portfolio capital. All right. Corruption levels is a part of the governance. Perception of high levels of corruption can deter foreign investors due to the concern about delays, opacity, and potential risk to their investments. And these are also the part of political unrest. Okay. Capital controls. Restrictions on the capital account transactions, such as bans, quotas, and taxes, can limit foreign portfolio investment inflows by creating a barriers to investment and repatriation of funds. It means that the more open ground you will give, the more investments will be there. Okay. Thereafter, sector restrictions. Some countries impose restrictions on the foreign ownership in certain sectors, like the defense, telecommunications, or the banking. These restrictions can limit the opportunities for the FPI in specific industries. But these are important from the national security point of view. Countries may set limits on the percentage of a company that can be owned by the foreign investors. These limits can vary by industry or type of investment and can impact the attractiveness of investing in a particular country. All right. Regulatory approval. Foreign portfolio investments may require regulatory approval in some countries. The regulatory process can be complex and time consuming, okay, so that it may deter the foreign investors. Currency control. Some countries impose controls on the movement of the capital in and out of the country. These controls can restrict the ability of foreign investors to repatriate their funds, affecting the attractiveness of foreign portfolio investment. It means that maybe there is a limit in investment, that up to this much of investment you could do by using that particular currency, and you can say only up to this much of amount you could withdraw from the gains you have completed into the country, right? Taxation policy. Tax policies can significantly impact the returns on the foreign portfolio investments. Country with favorable tax policies, also known as tax havens, may attract more foreign investments. Trading restrictions. Some countries impose restrictions on the trading activities, such as short selling or trading in certain securities. These restrictions can affect the liquidity and efficiency of the market, influencing foreign portfolio investments decision. Disclosure requirements. Countries may require foreign investors to disclose their holdings and investment activities. These disclosure requirements can vary in the complexity and may impact the transparency of the investment environment. All right. Thereafter, the AML and the KYC norms. Foreign investors are often subject to the anti-money laundering and the KYC regulations, so that they are required to verify the identity of their clients and ensure that their funds are not being used for illicit, also we call it the illegal. Okay. Like in the, you can say, FII's lecture, also we have seen that the investors are basically required to disclose the source of fund, from where they are getting the funding or from where the fund is coming, so that the anti-money laundering things could be protected. And that's why the companies in which they are investing, they are required to follow the KYC and you can say know your customer. Compliance with these regulations can add it to the complexity and cost of foreign portfolio investments. All right, but these are necessary from the you can say national securities point of view. Thereafter, the political and the economic stability, we had already seen that the countries that are politically and economically stable are more attractive to the foreign investors. Political instability, or you can say the economic uncertainty, can increase the perceived risk of investing in a country, impacting the foreign portfolio investment. Some countries impose restrictions on the repatriation of the funds by the foreign investors. These restrictions can affect the liquidity of the investments and the ability of investor to realize returns. Okay. After finishing this, now we have the conclusion. In conclusion, FDI, FII, and FPI plays a significant roles in the global economy, facilitating cross-border investments and promoting the economic growth. All right. FDI involves long-term investments in a foreign country, often leading to the technology transfer, job creation, infrastructure development. FIIs are institutional investors who invest in the stock markets of the foreign countries, providing liquidity and stability to the markets. All right. FPI, on the other hand, includes both institutional and the individual investors who invest in financial assets such as stocks and bonds, often seeking short-term returns. All right. While the FDI is typically seen as beneficial for the host country economy, providing capital and expertise, it can also raise concern about loss of control over key industry. Okay, because you can say the swift and the quick withdrawal may bring the instability in the market. All right. FIIs and FPI can bring volatility to financial markets, but they also contribute to the market liquidity and the efficiency. Okay. All the things we have already discussed. Overall, at last, we could say balance between attracting the foreign investments and ensuring regulatory oversight is crucial for maximizing the benefits of FDI, FII, and FPI while minimizing their potential risk. Okay. So basically, students, in this lecture, we have finished the foreign investments. In the next lecture, we will continue with the other important topic. Till then, just revise all the facts and figures which we have discussed in this lecture. Because if you are not doing these things, then as you can see that we are covering lectures and lectures, we are covering topics and topics. Okay, we have finished so many topics so far. So what will happen that if you are not doing this, the things will be compiled up on your mind, and you will be not, you can say, able. You will not be able when you will revising the facts and figures to recall all the things which we had discussed in this lecture. Okay, so that's why it's my humble request to all of you, kindly revise all the facts and figures in a proper sense before you go for another lecture. With this note, let's end this lecture. And what do we say? We say thank you.